All right, good afternoon, Mrs. Smith. How are you?
I'm good. How are you?
I'm doing very good, thank you. Okay, so I was going through my notes from our first meeting and I saw that you were looking to buy a house and you've been saving up for a down payment. Can you take me through that a little bit more?
Yeah, we're actually looking to buy a house in and around the $500,000 range.
Okay.
And we've been saving up for a down payment, but we're not sure how much we're gonna need.
Okay, well that's very good. Do you know how mortgages work?
No, I would like to know more about them.
Okay, of course. So I'll take you through that. So mortgages are specific loans that are used to buy a house. So every time you hear the term mortgage, just think of it as a house loan. Okay? And there are two different types of mortgages. There is a conventional mortgage and there's a high ratio mortgage.
Right.
Your conventional mortgage is a regular mortgage in which the bank will give you a loan which is 80% of the value of the house. So as an example, if you're buying a house that's $500,000, the bank will give you 80% of it, which is $400,000. That means that the rest of the 20%, which is the $100,000, that has to come out of your pocket.
Right.
Okay. And now let's just say you can't come up with $100,000 because it is a significant amount.
Yeah.
What happens next? In that case, you would have to go for a high ratio mortgage, in which the maximum amount of loan that you get from a bank is 95% of the value of the home.
Okay.
Very, very significant.
Yeah.
So instead of, let's say, instead of the 400,000, the bank would give you 475,000 as a mortgage, and then you would have to come up with the 25,000 from out of your pocket.
Right.
Okay. Now there is a catch to it. The catch is that you must get and pay for mortgage insurance. Mortgage insurance is essentially a peace of mind, a security for the bank. So in case that the customer isn't able to afford his mortgage payments, the insurance company will pay the bank so that they get what they're owed.
Right.
Okay, and you're paying the premium, so it all works out.
Yeah.
But the bank is the one that's purchasing the mortgage insurance, so they buy what's best for them, but you're the one that's paying the premiums. The CHMC stands for Canada Housing Mortgage Corporation, which is the company that the bank is buying the insurance from. Okay,
Right.
it's a corporation.
Okay.
So you understand the first part.
Yeah.
There are two types of interest rates. I'm sure you've heard about that: fixed rate and a variable rate.
Yeah.
So your fixed rate is an interest rate that stays the same throughout the term, very straightforward, and your variable rate is interest rate that will fluctuate depending on the prime rate. So if the prime rate goes up, your interest rates are going to go up. Your prime rate goes down, interest rates are going to go down, vice versa. Okay? You would want a fixed rate if the interest rates in the future are going to go up.
Yeah.
And you would want a variable rate if the interest rates in the future are going to go down. There is no way to tell whether they're going to go up or down. It's just according to your research and what you feel like is going to happen. Okay? So amortization versus term. So these are terms that are going to be used a lot in a bank. So amortization is the length of time that takes for you to pay off your entire mortgage loan. Okay? And the word term refers to chunks of time that the amortization period is divided into. So let's say your amortization period, it could be anywhere from 15 to 30 years. Normally it's 25 years, like the average most people get. So 25 years. So your term could be 5 years divided into 5 years. So it could be 5, 10 years, then 15 years, then 20 years, and then 25 is the end. So at the end of every 5 years, at the end of every term, you can renegotiate your mortgage. So you could, what can you renegotiate? Well, you can renegotiate your interest rates. So you could, let's say the first 5 years you had a variable interest rate, the next 5 years you could have a fixed interest rate.
Okay.
So at the end of every 5 years, you can go to the bank and renegotiate your contract and tell them that you would want a fixed rate, and then you can. That's how these terms and amortization works. Okay. So do you have any questions, any concerns?
No, I'm good. Thank you very much.
Of course. So thank you very much for your time. I hope I was able to help you out with mortgages. I hope you learned something today, and I wish you and Mr. Smith the best of luck in buying a home.
Thank you
okay?
very much.
All right. Thank you very much.
Bye-bye.
Take care. Bye bye.